Thanks for joining. It's a pleasure having you guys on the call once again. Familiar faces, yeah, Ebuka, um, yeah, Ebuka, I know that's a familiar face. Savior as well, familiar face. Mike, you're welcome. Just to welcome a few of you to the call. Um, and I think that it's going to be a very interesting conversation. But before we start, Ben, do you just want to tell us a bit about your experience? I know you it's usually I usually like people telling us about themselves because there's just
Yeah.
something you didn't write down that will be, awesomely important, right? For the audience to hear. So how did you even get into investment? How did you start? What did you study? We've had some fantastic journey from
Mhm.
our speakers, and we've also seen some transition. Sometimes we always assume that when you get into investments, maybe you studied investment in school or accounting or something just related to investment or management and the rest of it. But
Mm.
people come from zoology, from engineering. Our last speaker even came from civil engineering and the rest of it is masters as well, all the way to engineering. So let's hear your background and then I think that we can just kick off the session.
Interesting. Yeah. Thanks for that. That just shows that it's not a one size fits all journey, right? There are different roads to the market, so to speak. So for me, I studied business management and computer studies uh, at Zenith University College in Accra, Ghana. But I didn't even finish the program, right? I had to travel back to Nigeria to focus on other things. So I went through Founders Institute. Some of us might know Founders Institute, FI, as they
Yeah,
are
yeah,
called.
fine. Yeah.
Their Yes, their very first cohort in Lagos. I was part of that very first cohort in Lagos, and I was just hungry to test out some ideas, some solutions, and so I joined up, went through the program track, and I stumbled upon this idea to build a decentralized checkout system in physical retail stores. So you don't have to queue to check out your items, just scan the barcode and all of that. Similar to what some of us might know, Jump and Pass,
Hmm.
similar to what our startup is currently doing now. But guess what? I built out the MVP, but I never got to launch. It failed woefully. Uh,
Wow.
it didn't just fail, it
Another
failed woefully.
interesting story.
Yeah, and it failed for two reasons, particularly. One, bad hire, because I was new in this space. I wasn't sure of how to source quality talent. And so my developers just, made a mess of it. But second thing is lack of access to capital, right? Because if I had gotten some angel funds to test out the ideas properly, it would have turned out to be something. And so and this was in 2019, right? As at 2019, you weren't even sure who was funding what at the time.
Hmm.
It's not as we have it now that there are series of spreadsheets and databases that you can just see list of VCs and all that. 2019, you had to really, really build out your social capital. And so I folded up, right? The startup folded up. Same here. And then a few years later, I I stumbled upon venture scouting through one of my partners back then as well. And so I became very eager, very curious to see how I can be a part of building a bridge where founders don't really have to shut down, right? Where founders get access to the right kind of investors, get access to the required capital to keep the lamps on, to keep the business going in the short term. So yeah, what turned out to be a failure, so to speak, eventually turned out to be something I find myself building solutions for or building a bridge for today.
Interesting.
So yeah.
Interesting. That's very interesting, Johnny, Ben. So I just go straight right into some of my questions for you. And then the way the session usually would go is that we would have the audience raise up their hands if they have questions, if they want to ask you or stop you at any point in time, they just raise up their hands and then we can take questions at interval. But I'll just moderate the session. Today's session is from hype to substance, building trust between founders and funders. I think that what I would want you to do is just give some clarity to the subject itself in a few minutes before I start to deep dive into some of my questions.
Okay, yeah, thanks. So from a hype to substance, um, as we have seen in the past few years within the African venture ecosystem, we've seen that in 2020, 2018, 2019, there was this sort of bubble where a lot of founders, regardless of your background or what you were building, there was just access to capital, right? Everybody was funding. Sorry, can you hear background noise from my side, or is it really distracting?
No, 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 it's
No,
fine. It's fine. I think it's clear. It's fine.
Okay, cool. Yeah, so founders really got access to capital pre-COVID, regardless of what you were building. So there was this hype within the African venture ecosystem, and investors from other climes and other regions were really picking interest in Africa. And it was beautiful to see. Yes, did they fund some amazing ideas? Of course. But were there some ideas they funded then that we've just seen the abysmal failure, as we're seeing now? Yes, we've also seen that. And we're not putting that on the founders exactly, right? Different structural issues might have been the reason why they shut down. But what is now happening now is the market is correcting itself. We are seeing that investors are not just chasing founders that have the background that excites them or that have
Clouds, you mean?
come again?
Clouds. You're not chasing clouds anymore.
They're not chasing clouds. They're after the real deal, right? And so there's not a question of trust. Can an investor build trust with the founder? Is there credibility among the founder ecosystem that founders can say, okay, we can place a bet on this guy and we're going to see it, come to fruition. So it's just been that transition over the years. And I'm particularly excited because having been a scout for up to 4 years now, I've seen founders also go from obscurity to saying, okay, you know what? I think it's time to build to last. It's time to build what will actually make impact in the real economy. So yeah, it's about that time to just build something of substance as against chasing the vanity metrics and all that.
All right. So I know
Yeah.
that many African founders chase visibility and hype, right? For their businesses,
Mhm.
right? Because that's what used to be the pattern. But in your view, what's
Hmm.
the difference between signals that attract investors and noise that distracts them?
Hmm. Let me start from the noise that distracts them. So investors, should I say, they are becoming smarter by the day as well as things are unfolding. They wouldn't pick an interest in a founder that, all they see on his LinkedIn post and what he sees as out at, or what the founder sees as traction is attending tech events and just being out there and all that. Yes, can you use it to validate your product or for marketing activation? Yes, you can. But founders tend to overhype or place too much value in just being out there, associating themselves with certain people. And investors are like, no, 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 no. Are you also putting time into building your products and not just traveling around for events? The second noise you'd find out there is founders big on awards, right? Awards again is not doesn't necessarily translate to an amazing business. Yes, it could serve as a recognition for good work done or a job well done, but it doesn't necessarily validate that your business is venture scalable, is worth investment capital on investor money. So those are some of the noise that VCs are starting to declutter and to cut through to say, you know what? Beyond all of these things, let's focus on the real deal. And some of the substance that VCs are going for is actual impact. Now, impact means several things to many VCs. To some VCs, impact could be, okay, you've X'd your number of users over time, like you've 2X'd it or 3X'd it. Or impact could be, yeah, when it comes to revenue, like actual traction, how have you grown month on month or quarter over quarter? That is what is really piquing the interest of VCs. Yes, you can be a good storyteller. You can be out there every other day, every other event. You can win grants and multiple awards, but if it doesn't translate to your growth in terms of numbers, you really won't get investor interest these days. It's a bit a struggle. Sorry, you're muted.
Thanks, Ben. In my own experience, I also find that a lot of founders are pressured to present a perfect story. You know, how can they balance that ambition of, every time you go for a pitch session, right? They say, oh, it's the story. Investors are interested in the story, right? And sometimes, I sometimes hear true founders who are telling stories that are not as sorry, Ebuka, I'm going to have to mute you. Founders who tell stories that are not honestly true, right? You can see through the story and know that it's a joint story, right? Or it's a perfect story that sounds true to be realistic, right? But let me use the story of when I was going to school, I never had slippers or sandals, right? So that made me now start thinking of having a business that would allow, some stories that are, when you hear them, like I think I've heard this kind of story before. Well, it might be the truth, but you're looking for that perfect story. Right?
Yeah.
How can they balance this ambition with, being transparent about, the risks and challenges that they face in the business beyond just presenting a perfect story?
Yeah. That chase of perfection is real. Trust me. Every founder don't want to fall short in any way imaginable. But I would say that rather than chasing the perfect story, be real. Be as real as you can be, because investors can literally see through you sometimes, like literally. But they just won't mention it. In fact, you might not know why they are passing on your startup, right? Why they've moved on to other startups. Perhaps it just might be that you are presenting a too perfect a story, and then they're like, nah, this guy hasn't really done his diligence. Or and this thing you said is very real. I've seen founders even curate their pitch deck in a way that it just seems to speak uh, um, the language of VCs to whet their appetite on certain. No, 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 no. I think one way to go about it
Ben,
is
I think you're breaking, Ben. I don't know if it's me, but I think you're breaking for a minute.
Yes, it's breaking. It's breaking.
Okay, let's just give him a minute.
understanding that.
Sorry, Ben. I think you were breaking for a
Oh,
minute.
okay.
Yeah, so maybe a call is coming in on your network. Yeah, but you can go again.
It must be. How's it now?
Yeah, it's much better. Much better.
Is it better?
Yes, please. Yes,
Okay,
please. Yeah.
cool. Yeah,
I said
yeah.
you see
So
founders have in their pitch
I
deck,
would,
VC's lingua and the rest of it. So you can just start from there.
yeah. So you see all of that, and you're wondering, this guy's probably been around for a while, but is he really building something that would last, or is just chasing the VC metrics and the VC narrative to get the VC money? And in that bit, you just want to be very perfect, pitch perfect for the VC. I would say that again, reiterating, be real. You don't have to cook up abstract stories, like make it very contextual. You don't have to be like, oh, when I was in school, I didn't have his sandals and I trekked to school and all that. No, 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 no. You can actually just it doesn't have to be a personal journey. It could just be a problem you cited while researching or going online to randomly I say, okay, this problem is worth solving for, and then you delve into it. So when it comes to storytelling or how you're putting yourself out there, be as real as possible. Your numbers have to be as real as possible. In fact, what intrigues, or what piques the interest of VCs is seeing is seeing your journey mapping, which is how you stumbled upon your initial idea, how it didn't work out, and the different pivots you've had to make as well, just to make sure that you're chasing that problem market fit or solution market fit. So it's in your journey really. It's in how you've made mistakes. It's in your failures. It's in how you got back from your failures that VCs are really looking out for. and not the fact that, oh, from day one, you've just been hitting it and you've just been blazing through. Yes, are there cases where you can actually blaze through? Yeah, there could be, but founder journey, as we know, is usually not a straight line. So as much as possible, be real, be very real, and then you pick the interest of the right VCs.
Yeah. So speaking to metrics or measures for investment now, right? I mean, in today's market where capital is even very tight, right, and very slim, and investors are looking for certain things. What are those things that you think that, as a scout, previous scout, I'm sure now you're also looking at some business to invest in. But as a scout, what are those things that would pique your interest, that would tell you that there's a potential in this startup?
Interesting.
Beyond
Yeah.
attractions and all other numbers that some founders are more particular about these days.
Yeah. So beyond the numbers, I would say the space you're playing in. Trust me, I see a lot of pitch decks across Sub-Saharan Africa, and I'm like, yeah, this is just copy and paste, no differentiation really. Like you can literally say that this guy just copied and pasted. And so as much as possible, I'm always looking out for a differentiation. It doesn't have to be loud. It doesn't, you don't even have to have solidified it, but are you on your way to actually building out your differentiation, your moat, as we call it, your unique advantage? It could be a network effect. It could be partnerships. It could be and now you're layering tech solutions or AI integration, whatever it could be, but let's say something different, right? Let's say something different that could whet the appetite of investors. So your unique value prop or proposition, as we call it, would always be a go-to to determine if you're building something different. Yeah. The second would be your founder background. Yes, this one is very, very key. Um, and it's not it's just where we find ourselves as an ecosystem where one of the ways to tell how credible a founder is looking at his previous experiences or his previous engagements. So this is typically would want to go for founders who have been exactly specifically ex-founders. So maybe one ex-founder, two ex-founder, three ex-founder, which means they've gone through the grind, they have the experience, they know what it takes to build and to build something of substance. Another background that's very key, apart from being a repeat founder, is having sort of like a consulting background. And that would tell that, okay, you have a level of grit, you have a level of attention to detail and diligence. Another background, so to speak, would be that a founder has domain expertise. So maybe you've been playing within that ecosystem for a while, and then you just decided to branch out to found a startup within that same sector. So domain expertise is always a win for VCs, right? Because if you have domain expertise, they could even prefer to invest in your business than invest in a startup which has a better traction, but the founder doesn't have depth, right? Because they know that when push comes to shove and when the tides really get tough, you can navigate things very seamlessly, so to speak. So those are a few founder background I can speak to. If I were to highlight another thing VCs look out for in determining whether this is a startup worth investing in, it would also be the market timing, so to speak, or market execution. I think I'd prefer that one. How are you executing? I've seen startups play in the same space. Maybe pick a TradeFi, for example, trade finance, but how they're approaching the markets is very, 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 super important, right? Um, how are you layering third-party solutions or third-party service providers on top of your solution? How are you leveraging ecosystems to build out your solution in a way that is scalable? You're not burning too much capital, but you're also hitting traction, right? So execution is always most times differentiator between why if a VC would go for yours as against other startups. Yeah.
Yeah. So Ben, I want to ask you what your take is on building in public as a founder, right? Where you're putting out your numbers, you're showing your journey, your growth, your experiences, your challenges, your interactions with your customers or real customers, building in public, just basically saying how your journey is going as a founder. Does that also
Mm.
interest an investor? For a founder, again, the subject is hype and from hype to substance, right? Would that
Yeah.
also mean that that's substance, or you you would see it as hype as an investor?
As an investor, it's hype. Um, is it good to put yourself out there to sort of carry your stakeholders along in your journey as a founder? Yes, it's not terrible. But from an investor lens, some investors could see it as distraction, like you're distracted. Why are you so busy posting and telling stories when you should be spending as much time building the actual stuff? Which is why, in fact, I generally don't scout for startups that are too popular or really out there. I've been very fortunate to find some very amazing startups that a lot of people haven't heard of, but what they've built is just amazing, right? Like those low-key kind of founders are like my best bets these days because when VCs see them, they're like, where has this guys been? And they've really built out something amazing. So you just take them unawares and they're like, oh, okay, wow, this guy is something. So VCs see a lot of that as distraction for the most part, right? So focus on build in silence. You don't even know who's watching you. A computer might be picking one or two components from your startup, and then before you execute, they've probably gone on to execute on your yeah, and then
Your
you just
idea.
get to lose out of it.
Hmm.
So
Yeah.
as much as possible, have that diligence to take the time out to build in silence. And at best, if you want to make noise, you can curate an investor update, as we call it. So you have people you send monthly newsletters to or monthly updates to people you call your key or core stakeholders, whether it's customers, clients, potential clients, partners, or potential investors, that gets update from you every once in a while. But you going fully public on it, it's just too much energy.
Hmm. So if I hear you right, do you think that hype is harmful? Because for some founders, it's worked already, and for some, maybe their stories are not just at the right point. So do you think that hype is really bad?
Hype is not terrible, but if it's used strategically, it could turn out to be a game changer.
Hmm.
Yeah, hype is
You
not
want to paint a
terrible.
scenario of that for us, where hype might look like it works, and it's still working.
Okay, I'll have to paint an hypothetical one. So imagine you're building a fintech startup helping informal retailers scale more.
Hmm.
Maybe think of a child deck, for example, or something like that, a fintech or marketplace, so to speak. And then you're always big on telling the stories of the amala seller on your platform or the rice seller on your platform and all of that. And all of a sudden, something really happened with one of your customers. And then you really honed in on the story to do some research and to find out that, oh, this was why the customer or this was why this particular retailer or seller faced this kind of issue. So that's how you can hone in on key stories or key contextual expressions of your customers that could even resonate with more of your customer segment and be like, these guys are very particular about how they solve customers' pain point on your platform. Or business can be like, okay, I think these guys are cracking something in the space that other people have not yet cracked. So it's not just about the noise, it's being if my agile strategic is really seeing how you can pick into certain contexts and sort of blow it open in a way that doesn't just make your brand feel like the good brand, but a brand solving particular pain points
Hmm.
as well for customer segments. Yeah.
That's quite interesting. So from your seat as a venture scout, um, How do you separate promising founders from those who simply chase hype? How do you separate them? Are there like
Ah,
are there like clear indications that this founder is just a hype founder?
so it's not necessarily clear, which is why VCs would have to jump on multiple calls with you before they even have any sense of conviction. And trust me, I've launched fundraise campaign for well over 150 tech startups across sub-Saharan Africa. So I've met several caliber of founders.
Do
But
you want
one
to
thing
share
for
some calibers of founders with us? Just paint those scenarios so that we know where we sit. Maybe we're in one of those founders.
oh good. So I mean, man, I'm careful not to mention names
No
actually.
names, just characters, right? Like
Character.
traits, traits that make us say, okay, I think I'm that person. I think I'm trying to go into that shoes.
Yeah, so I've spoken with some founders who are not necessarily upfront, who are not thoroughly honest. So for example, I was working with this founder some time ago. Amazing traction, amazing business. But when the VC started running due diligence on that founder, he found out that there's a huge or gross misconduct among the founder and female employees. And that just blew up. Now that could even come back to bite me as a scout, because that would tell on my reputation on not being diligent enough to even vet my own startups before pushing to VCs. So I've seen experiences like that. I've also seen founders who are not big on taking feedbacks.
Mm.
When you are carefully and emphatically emphasizing that no, you guys need to really work on this component. And his response is to tell you, okay, why what he has built so far will work, why it will work. No, no, no. Are you actually do you objectively take feedbacks? Or do you ask the right questions? So I've seen founders really, really suffer for it when they don't take feedbacks or take it the right way. Right. And I've just been very privileged to work with other founders who I give them a feedback. Next 3, 4 weeks times they've implemented it, and I'm like, oh wow, this is good. Now that's a good trait. That's an amazing trait. So how do you take feedbacks from VCs or funders or scouts or anybody helping you build or modify your business to raise capital, so to speak? So those are a few things I can speak to for now.
So, so,
Uh,
so Ben, let me jump in there, right? Because I speak to founders a lot, right? And some founders will tell you, well, yes, I know that this VC has the funds, but what if he doesn't have the domain experience, right? And he's asking me to focus on a particular aspect of where my business, as a founder, I know that this is the problem I want to solve, right? How do I balance what the VC wants me to do versus getting his funds or our funds, and then also not going off my roadmap, right? Because of course, what we want to also see is founders who are focused on their roadmap, right? Um,
yeah,
what if
yeah.
that's going to cost me a lot of money to build what the VC wants me to build out, right? So again, how do we separate VCs who have the money but just wants to direct us to another path as founders?
Man, that's a big question. We are trying to address the elephant in the room this time. Because this thing is so real, man. I've seen founders come back to say, man, I wish I hadn't taken that VC money. Right? The pressure they've mounted on us, the direction they've taken us to, like they've taken us on a different route entirely from what we initially wanted to build out. I think as a founder, actually looking to raise capital, you'd have to two things. First thing, run as far as VCs run due diligence on you as a founder. Take time to run extensive due diligence on the VC to find out how they think, how they operate, how controlling they can be, how they've actually helped portfolio startups, get in the right direction, right? How the relationship really is between themselves and founders in their portfolio. So take time to run due diligence. What does that mean to run due diligence on VCs?
I was going to
Beyond the
I was going to
website.
ask you that, Benjamin, because on many calls that we've had on Umbrella Saturday, I've heard
Yeah.
conversation on to founders where the speakers are saying run due diligence on investors. Oga, how about if I don't even know what to do? How about just break it down step by step, what I should do beyond just a LinkedIn profile, beyond you telling me to go speak to the founders that he's raised, that he has invested in or not? How do I go about this? Do I need any technical knowledge? Just break it down for us, please.
So again, it's also depends on how deep you want to go. One thing you said already stands true. You definitely want to speak with their portfolio founders because you can get actual testimonials from them. That's the very first step, actually. So speak to their portfolio, a range of them. Don't just speak to their favorite portfolio startup founders, right? Speak to a range of them to get different feedbacks and insights as to how they've been able to work with those kind of VCs. Second would be, yeah, you can also have your own testimonial, your own set of questionnaires rather. So when you're speaking to a VC, as they're throwing you question, also take time to okay, how do you support a startup going through a pivot in their solutions? How do you support them with legal and regulations? How do you support them with ecosystem partnerships or paint a scenario of how that has worked out with one of your portfolio companies? Like put them on the spot as much as possible, and hopefully you'll be able to juice out one or two insights as to how they think, how they operate as a fund, and how they deliver to founders, and not just VCs that sit and wait for investor updates once every quarter and always looking out for your metrics.
So as a founder, would the red flag for me be when the investors does on the call, right? Would that be my red flag?
Honestly, you should think about it when an investor is not very confident about some of the questions you're asking them. That just means, hey, they've
Or he tells me, oh, sorry, I have a hard stop. Should I be rethinking the conversation with the investor? Especially when my question seems like they're too much.
yeah, I think an investor looking to it's like courting, it's like a relationship. Both parties really have to make time for each other. Both really have to make time to cater for one another. So as much as you're making time for the VCs, I believe they should make time for you to even answer some of your key concerns or questions. So if the VC is being too hasty to evade or to leave a call or strategically evading your questions, that's a red flag. Like you can call them out on it to say, okay, no, but you've not answered this, you've not responded to this. So take time to actually turn the table around, put them on the spot, and yeah, from their responses, if you think they are good to go, fine. If you think, my gut tells me no, then just follow your guts.
Ben, that's a hard decision, but let's hear from the founders, especially when you're looking for money, you have a
For money,
that's a hard decision
man.
to make, but let's hear from the founders. Are there any questions in the audience? You could just quickly raise up your hand. Let's quickly take some for Ben. It could also be your experience you want to share with a VC. Ben has clarity. Ben is somebody in this industry that me, personally, I even want to go to school to go and learn one or two things.
I'm loyal.
All right. So any questions, please just quickly raise your hands if you have questions for Ben. But Ben, I would go back to a bit of questions around the investor side. What are those red flags that investors really see before not committing? There are some deals. In fact, I feel like sometimes investors know that they're not going to invest in founders and they waste executive time. That's what I like to call it. Because for me as a founder, that's my executive time. That's business time that I should put on calls, right? Or speaking to my customers, or even doing research, R&D, or even pivoting my products if I'm the technical founder, right? But I give that time to investors, and the investor knows he's not going to invest, right? You take me through, you've seen the red flag in me. Why don't you just tell me in like an email and say, in fact, the generic emails, I think that VCs invest
Yeah.
need to stop those generic emails or accelerator programs or grants. You need to stop sending me those generic emails because you're not helping me know as a founder where I failed.
Interesting.
So if you have 1,000, I know you can't go through 1,000, but if you took time to go through 1,000 decks, you noted what the errors are, true or false. As a scout, right?
Definitely.
You said, "Oh, I'm not going with this guy because he doesn't have X or Y." Or why don't you just send me back those feedback? I'm sorry I'm putting you on the spot, Ben, but I need you to answer this question.
No. But I'm also trying to get your question right. So red flags from the perspective of investors to founders.
Yes, to founders. But why do they also waste so much time with these founders when they know they've seen the red flags?
Well, why they waste so much time is, again, for them, it's just extra admin work that they'd rather not do. So imagine, and most of them have, most analysts or associates, they have like hard targets of perusing or scrutinizing maybe 50 deals in a month or 70 deals in a month, some as much as 100 deals in a month. So they just want to look through a deal, give their reports, or look through a deal and just to show that, yeah, I've gone through this deal. But that extra admin work of going back to actually email the founder, okay, these are the reasons why we are passing on a deal, is extra admin work that they rather not do. And guess what? The VC model is most VCs run very lean teams. So there's no extra hands on board to help them circle back with the founders to answer any extra questions or whatnot. Right. So they rather not just get into that. As far as they're meeting their own KPIs, well, you founders, you'll be fine if you don't hear from us. And it's not great. It's not good. I've found myself calling out a lot of VCs for this over the years. Like I literally call them out. I'll email them. Okay, no, have you shared feedback with the founders? And I just love VCs that are very proactive and they actually detail why they're passing on a deal. I'm like, oh, okay, now this is a learning curve for the founder to actually go back to the drawing board to say, okay, I think let's tweak this, let's tweak that. Particularly, I'm not even being biased, particularly Kenyan-based funds or East African-based funds, they are very, very good at giving good feedbacks. And it's something that I wish would see more often within the space. Right. So, yeah.
All right, great. Thanks, Ben. So, but what are those red flags that you think that investors see in founders?
Red flags investors see in founders. Big one is valuation. Founders, man, this is even a struggle for me as a scout. You're raising 1.5 million pre-seed and your valuation is 17 million, $15 million. Why? How are you? What's the context? What valuation method did you even use? Most of them, so founders I've found out are not very savvy when it comes to using actual valuation method. They just look at their numbers and then use multiples to say, okay, I think in the next few years, this is where we're going to be. So how you value your startup is very, very key. Please, investors are very, very sensitive when it comes to valuation. You can't afford to blow a number at them. In fact, that's the very first red flag. When they see your valuation and they think it's too high, that won't even create a room to have a conversation with them because they're like, is that this founder is being overly ambitious or he hasn't done his due diligence to find out where he should be raising at. There's no perfect number for valuation, but there's always a very good place to be, right? That could at least spark up a conversation with a VC. So poor valuation or overvaluing your business is definitely a red flag. Another I see are founders working multiple jobs because from the VC side, they're like, why are you working multiple jobs? Like you're co-founding two startups and you're working at a multinational. How are you finding time to build this actual startup you're fundraising for? So it's a red flag. They're like, nah, this guy won't be as focused or as committed to building this venture. Because if it fails, he has a fallback option, right? I spoke to a founder lately and he gave me a reason why he can't just be building a startup only. He's like, man, he has mouths to feed, right? He can't focus on building a startup that isn't even revenue positive, not talk of scaling well enough to fend for himself. He's still pouring money into it. So why should he not want to have another job? And which makes perfect sense too. But from the
And
VC
in
side,
the nuances of Africa, isn't that the reality that we face?
Actually,
And the initial that you mentioned, isn't that a Silicon Valley model?
it is, which is why I'm trusting that a couple of accelerators that we'll start to see that are African birthed would be able to address some of these nuances we've copied from Silicon Valley, actually. So yeah, those are two red flags: valuation, founders working multiple jobs. Something that's sort of it's not necessarily a red flag, but investors are being wary of are founders that don't have like an advisory team or a board, people that can offer very strategic insights or steer the company in a particular direction. Because they're like, if and because why that is important is the founders are not accountable to anybody else other than themselves. And when a founder does not have an accountability structure, that's where you see mismanagement of funds, mismanagement of this and that. So, or gross misconduct within the workplace. So, not having a very strong advisory board could also serve as a red flag. It's not a big deal, but some VCs really see it as something that founders would want to cater to. Which other red flag? When it comes to due diligence, please. So I spoke with a founder 2 days ago, and I was like, please, as much as possible, if you're not a finance person, if your co-founder is not a finance person, actually employ or hire a financier, someone that can help you work your financial modeling and projections to be as accurate and crisp as possible. Because I've seen VCs come back to tell me, man, Ben, would have invested in that startup if only that um, the only reason we didn't go on was the numbers didn't add up. Yeah, it didn't add up there. So just being very particular about your numbers could also be the game changer for VCs. There are a couple, but I think I'll just stop here for now.
All right, thanks, Ben. The comment section is buzzing. Like, I'm wondering what's happening there, but let me just go there. So, someone says, how do you source for deals? What value do you provide to founders while helping to launch fundraising campaigns? That's a direct question to you.
Okay, well, you help me to sell myself. If Iola gives me the platform, who am I?
Please sell yourself.
Okay, how do I source for deals? A couple of channels. Number one, I leverage founder network or referrals. So if I fundraise for a founder and is a top tier founder, when I mean top tier, they are there. They're good traction, growth stage founders. I would practically reach out to you to tell you, well, how about you introduce me to one or two of your friends that are also fundraising? And they're like, Ben, sure, why not? I have a few of them. Alpha. So that's like low-hanging fruits of how I source deals, right? Number one, founder network. Number two, I find myself partnering with a number of innovation hubs and accelerator programs, right? A couple of them are here in Nigeria, others scattered across Sub-Saharan Africa. So I partner with them because they have a portfolio of startups that they've probably worked with or worked on and would be looking to fundraise in the coming weeks or coming months. So you see me partnering with them to get their deals from them, to hop on their demo day just to peruse what they have. If they have any quality stuff, I'll definitely seek introductions and all that. So that's the second way, right? Partnering with innovation hubs and accelerators. The third on how I source deals is I also tend to leverage investor networks. So that's why I'm friends with a lot of investment analysts. And I actually source deals for well over 70 funds across Sub-Saharan Africa. So that's a lot of funds. So I'm friends with a lot of analysts, and how that practically works is I'll nudge them every once in a while. Oh, bro, share me some deals you guys are not looking to invest in. Deals you guys have passed on. Pass them, share them with me. Let me also have a look. Some might pique my interest, some won't. So I've also had those relationships where analysts or associates share their deals with me, or even deals that they are currently looking to co-invest in. They're like, oh, Ben, you have investor network. Can you help us push these deals? We're looking for a co-investor. So I can quickly leverage that as well to get quality deals at that. So yeah, I've just given you some of my onions, some of my secret sauce on how I source deals. The second part of the question, what value I provide to founders, helping them launch fundraise campaign. A few things. Number one, speaking of investment readiness, because you have to be prim and proper even before I introduce you to investors. So I want to make sure your numbers are good, your data room is all set up. So I sort of help with data room structuring as much as possible. I help with pitch deck reviews. If I think your pitch deck is good to go, I'll give you the thumbs up. If I think we need to tweak here, tweak there, I'll also give you that feedback as well. So helping you revamp your pitch deck and even pitch prep sessions. How do you speak to certain things in your pitch deck that VCs will just find interesting? Because I've been on multiple pitch calls over the years. So I just know what typically would pique the interest of VCs, and it won't come off as though you're wasting their time on that 30 minutes call. So another way I support founders is, so over the years, I've also built out a founder network. So if a founder is hiring or a founder is looking to partner with other startups, right? So startups providing solutions to other startups. So I can easily intro you to one or two founders. Oh, Alpha, check out this guy products, or patronize these guys. So yeah, I sort of help with connecting founders to other founders to, conduct business together. So those are some of the few.
Great, great. I was thinking you were also going to mention using platforms, right? So are there platforms where you also go sign up with and then also get founders deals into your pipeline?
Yeah, this is a big one. I tried Startup Lagos. I think they had this platform then, but it didn't scale. So I haven't seen as much platform. So Umbrella is definitely doing something amazing, but I won't lie, I should be more involved actually. But speaking of platforms, I haven't seen enough marketplace platforms like in Africa that, number one, showcases quality deals
Deals, yeah.
and it's updated as frequent as possible, right? Yeah.
All right. So the next question says, access to funds right now is hard. This is from Michael Olugbo Adeyemi. It says, access to funds right now is hard, and I currently at that. Okay, so it means I'm currently at that pre-launch risk or stage. I don't know if that's what it's trying to say. What I am learning is to be in constant fundraising mode all year round, but unfortunately, I am not a finance head. I am more technical minded with expertise and experience in my domain. If I were to bring in a co-founder, CFO with fundraising expertise post MVP build, what equity can be given and where can I find them? Two, how do we exactly value a startup with barely any traction? All right, Ben, that's your question.
Yeah. Very interesting. Let's tackle the first one. So you're looking to hire a CFO post MVP. What is the right equity to give out? Well, that can be a very technical question because, well, first I'd look at, of course, we want to keep like 10 or 20% for ESOP, employee stock option standard. You also want to look at the kind of expertise you're looking to hire when it comes to CFO. Like, what is the person's level of expertise? If the person is really there and very profound or renowned person, you really want to give out something that is worth their time, since you might not be paying in cash or paying as much in cash. So yeah, I definitely can't give you a figure on this call. I can just walk you through some of the things to think around as you think of giving an equity. Another thing to consider when it comes to giving an equity is, let me see. Try as much as possible so there are structures around equity already, which is beautiful. Making sure that at least the first year is cliff period, which means everybody is putting in the work, no equity is being given out. Second year, you want to think of vesting it over the next 3 to 4 years, right? So just putting that structure in place would help. But again, to think through it is to imagine if I'm getting a top tier CFO is 30% a good deal, or is 10% a good deal? If you're also thinking about giving equities to other co-founders who might be bringing on board, since you're a technical founder, so you're more like a CTO. If you're looking to bring on board a CMO, chief marketing officer, or any other executive role, and you're thinking of giving equities to these other people, then that should shape your decision and thinking, okay, let me give a CFO this slice of the pie, because other people would also have to take up slice of the pie, including VCs, and think of how that could also translate into being diluted as a founder. So really, there are materials to read up on. If maybe you could chat me up offline, I can share some materials to help guide you through that thinking process. Where can you find CFOs? Well, I'd say you leverage community. Yes, you can choose to put out a JD on LinkedIn or a hiring post on LinkedIn. Well, you can get a wide range of strange people applied to that role. But if you want to be as targeted, leverage founder communities as much as possible, or leverage operator communities. I belong to a few on Slack and on WhatsApp. So leverage those kind of communities, put out a request and get a few referrals. Yeah, that's what I'd suggest. Then how do we exactly value a startup with barely any traction? Well, one thing I'll think about is the stage of the product itself. So is it at a place where it's the MVP is ready, so to speak, and then it's just left for execution? So the stage of the product can determine how that startup will be valued. If you've signed any MOUs or SLAs with potential clients or potential now, MOUs is not the same as having a wait list. You can have a wait list, but nobody has signed with you. I see founders brag about wait list a lot. I forgot to mention this when we're talking about hype. All right.
So wait, this is the hype.
Wait list is hype. Oh. It's hype, man.
Because
Oh,
converting the wait list is the work.
yeah, exactly. Exactly. You can have 2,000 people on your wait list and then you're pushing out the news. But when you launch, who really is going to be your customer? So I'd rather prefer cogent, formal MOUs with certain corporates or clients, potential clients. That's the way to value a startup, even without actual traction. Yeah, those are the two I can think about. Another would hiring can be a form of traction. There's how you can hire a very strategic person
Sorry, Ben, your network is at it again.
to bring strategic
Sorry, Ben, your network is back at it. Maybe just give him time.
that a physicist will think of. Yeah, if you could hire this kind of.
Sorry, Ben, your network went out for a minute again. And your screen is broken. Are you back now?
Yes, I'm here. I'm here.
Okay.
Can you hear me?
Maybe just do a recap of what you were saying. I know that you said something around hiring. They call it
Yes.
the hire can also be a valuation metrics or something. Yeah, so you can go ahead.
Yes, absolutely. So there's how you can hire a kind of person on your team, and it could serve as a strong signal for VCs, right? Imagine hiring somebody from a top consulting firm or somebody from a well-established startup that played a significant role in that startup, and then you're able to bring them into your team. That could serve as a strong signal to VCs that, okay, if you're able to bring in this kind of person on board, then we definitely should pay attention to you, because I mean things might just you might just be on the verge of turning things around. So yeah, hiring can also serve as that, value for a startup without having any traction. So yeah, those are the few things I can speak to for now.
All right. Fee, I don't know why people don't want to speak today, but maybe they don't want their voice to be heard, but it's fine. Fee says, how do I determine evaluation for my startup? I think you mentioned a few of it already. What equity is appropriate for advisors? Well, I think it's almost the same question as how much should I give my team, my co-founders? I think it's almost the same question. I think for me, I would say think your cap table. Don't throw out equity because it would affect in the long run your cap table. So I think there are a lot of materials that maybe something we need to start thinking of collating African wide because some of those materials as well, Ben, I don't know if you agree with me, are still
Yeah.
Silicon Valley oriented,
Yeah. Yeah.
heavily Silicon Valley oriented. Maybe learn from some of the founders. I think my approach to it will be some of the founders who have raised, learn from
Mm-hmm.
Johnny and their story, and then someone can now say, this is a safe space. I don't know if anybody's doing that. I don't know if any AI tool, if anyone is also building any AI tool out there for the African markets within our space, which is investment and co, that would also help founders, just go there, put in what you think you should give out, and it tells you, oh, this is a red flag, this is a potential red flag. This is I don't know if you get what I'm saying, Ben.
Yeah. Yeah. Yeah.
I think
Absolutely.
our industry still needs a lot of builds, to be very honest.
Yeah, especially things that speak to our very own context.
Mm,
But if I were to take a stab at this question in 1 minute, I'd say how to, because somebody else asked, oh, Finn asked twice.
mm.
So thinking of equity for advisors, I would say first off, think of onboarding your advisors on a non-executive basis. So no equity at first. Let's test each other out. Let me get your expertise first. So maybe the first 6 months or 1 year, let's just build that relationship. Because founders can be too quick to give out equity to
And your
advisors that
advisor
might not
can
be as
also be a hype.
well, yeah, yeah. Right. But really think of working with them for a while as non-executive advisors. And when it's time to convert them, after you've tested them out and you're like, no, this guy is solid, this woman is solid, and you're thinking of onboarding them. I mean, I've seen founders give out 0.5% equity, 0.1% equity, or even 1% equity. Again, it boils down to how you're structuring your cap table and how much value you place on that person.
So, yeah. Yeah, I agree. Balogun. Okay, so guys, you can actually unmute yourself. Just raise your hands and then I'll unmute you so that you can speak. But Balogun Tolu Lokme says that what's that one hyped strategy you tried that didn't work? And then what did you learn from it? When you were building, maybe perhaps when you had your field startup.
Ah, you're putting me on the spot, really. One hype strategy that didn't work. Hmm.
Or maybe something that you see that is not working for founders, but founders keep doing them.
Okay. Again, if it's that, I think we've mentioned quite a couple already. But one hype strategy would be um, trying to force testimonials, perhaps. So,
Mm,
that's how you build out your solution, and then you're just trying to get testimonials from customers.
mm,
Uh, what I've seen works best is when it comes in very naturally, very organically,
mm,
right? And then that is a proof that you're building something very valuable. But when you have to force out those testimonials, and then some customers might just be tilted to speak well of you, even when you're not catering to their needs wholesomely or holistically, that might not be entirely great. That might not be entirely great. But because again, founders need those testimonials for the hype, right? To say, oh, so what our customers are saying about us. But I think what works naturally is that word of mouth approach where your customers are being your ambassadors and then they're pushing your brand out there on your behalf without you pushing for it or asking for it, so to speak.
mm.
But personally, I can't remember any personal hype strategy I've done in the past that maybe worked or didn't work. I'm very, very organic like that.
Mm. Okay, so Ben, I'm gonna ask you just back to some of our questions.
Mm,
Mm. How do investors themselves build trust in founders, especially in a market where some founders see investors as extractive?
mm. So how investors have to build trust with founders is, man, now this is a big one. VCs need to put themselves in the shoes of the founders themselves. Like they need to be as empathetic as possible. Like pull off that VC hats and actually put yourself in their shoes, right? Because what I've seen, some founders they might not know it, but I've seen VCs who would take, speaking of extractive,
Yeah.
they would want to speak to you and get and juice out as much information from you because they want to feed some of those insights to
So
a
they are
portfolio
portfolio company. Yeah.
who is obviously competing with you, right? But if VCs would put themselves in your shoes, they'll figure out that, man, this is not it's not easy building out already. So why would I want to do this to a founder? So VCs just choosing to be very honest with themselves um, is the way to go. Secondly, VCs proactively asking founders where they need help from. Most VCs, again, because of how lean their team is, they tend to shy away from a lot of admin work or operations work with founders. So they are not too quick to ask founders where you need help, right? But founders really need help every other day. So if VCs could really be more intentional about supporting founders where they need it and not just a sentence they put on their website. Oh, we are founder first. Oh, we are for founders by founders with founders. They use different things these days. Very strange slangs. But really
So
being,
Ben,
yeah.
isn't that the initial? I know that this is a fund the intermediaries, right, between the funders and this thing, and they have their own mandate. But shouldn't that in the startup world be the bridge?
Mm. How do you mean?
Like be the bridge, like help founders succeed so that they can have more successful portfolio companies.
Exactly. That should be the game. That should be the game. But for some reason, it's like, it's almost looking like a dog eats dog scenario or a very toxic space where if you're not performing as a founder, you're not worth the attention and the funding, right? You should be able founders build so you can make money for your LPs typically. But yeah, that has not just been the case. I think if VCs could think differently, the level of startup failure in itself would drop because we think, oh, why startups fail is because of poor timing, poor funding, poor this, poor that. Yes, pockets of truth there. But if VCs would proactively support founders as well, we could see some uptick in founders scaling beyond 5 years and all that. So I agree with you.
All right. There's a question from Michael. It says, what kind of cadence should be set up with advisors, one-on-one or group engagement, and what frequency? How best do we leverage them and become accountable to their advisory? Um,
Okay, okay.
I think that's a straight up question, but I just wanted to layer something on that question as well.
Mm.
Which will be how do you balance if you had three advisors or four advisors, how do you balance one advisor is telling you focus on something and another advisor is saying that thing that you are trying to focus on is not the focus on something else. How do you balance all of them? Do you bring them into this group engagement or you keep them separately? So that would be my
Yeah.
answer to that question.
Well, I think when you're being faced with, opposites advice or contradictory advice from two or more advisors, I'd say even before you bring them together, because bringing them together can be quite chaotic. You first run points with each of them. You can tell advisor A, oh, I hear you, but here's what my other advisor is saying. What are your thoughts on it or your opinion about it? Then you do the same for the other person. Here's what advisor B has to say about. Just have them think differently and see how they're able to adjust their thinking if they need to before you bring them together in a room. Because if you think of bringing them together in a room from the onset, that might be a bit chaotic. And that might also turn out to go well, so to speak. But I would say as much as possible, try to run points with them to see if they're able to adjust their thinking. And sometimes, as a founder, when you get contradictory advice from advisors, you might as well just get to be the one to call the shots, right? To follow your guts, to say, okay, I think I'll lean more towards this than this. Yeah. Because again, it's the onus falls back to you. You're the one building. You perhaps have more context than them, but they might just have more experience than you as well. So yeah, that's the way to navigate that. The cadence and frequency, I mean, some advisors are busier than others. Some might be on a monthly basis if they're not too busy. Some can be on a quarterly basis where they touch base with you once a quarter, and then it's very strategic. It's a very strategic session in that sense. Yeah, so that's what I can say with regards to the cadence or frequency. Yeah.
All right. Ben, I'm going to take you somewhere that you might not want to go. And that's a place where I'm going to ask you, what other things beyond funding do you think that founders should focus on? Right? Especially when an investor doesn't seem like he's promising to give you an investment, or the investment is not coming from the VC. What other things can I throw out there that can be beneficial for me as a founder?
What other things can we throw out there?
To an investor.
Beyond funding, is that a question?
Yes, beyond funding. Every time you're placed in front of an investor, most times founders think it's just, I'm looking to raise 850K, 1 million, $1.5 million. But the investor says, oh, okay, you know what? I don't think I'm investing right now. What other things should I put in front of that investor as a founder that might be beneficial for me? Is what I'm asking. So that you don't close the door to an investor just because he has said no to you, is what I'm get out of it.
Very key question. And founders tend to do that a lot. Once they get to know, they shut down. Some founders have hacked it to learn that it's relationship building. Because you tell me no today does not mean you cannot introduce me to a VC tomorrow who would invest, or you cannot even come back tomorrow to invest. I've seen VCs tell a founder no twice, but they came back to invest months later. So the first no shouldn't be it. But other things you can actually get out of their relationships are introductions, actually, because most investors sit in a very strategic role where they have access to operators, where they have access to corporates, where they have access to other startups that might just serve as your client base. So yes, you can't invest in my business today, but can you offer introductions to any strategic partner? Or yeah. So I've seen that also happen, and it's just so beautiful to see as well. So founders should be very proactive to learn how they can leverage these relationships. So again, access to resources or even access to other VCs that could potentially invest in the business rather than just shutting the door to say, well, it's a dead end with this VC. Yeah.
Thank you, Ben. Fee, you can unmute yourself and speak. I see your hands up.
Thank you very much, Ben. Thank you very much. This has been an insightful session. So here's my question. As a founder, say if a founder wants to raise and needs like some cash flow at a certain time, equity and the standard raising timeline, it takes some time. What's your perspective on debt or other financing instruments that the founder can use? If founder already has, say, he has partners who has MOUs with partners, and that he wants to get customers to like a marketplace and then earn on those connections. So you have a sort of like a market, and you need to raise money because the market would sort of like pay itself. Like, what sort of funding instruments could that founder consider? Yeah, that's my question. And how do you find those funding instruments? What's your advice?
Okay. Yeah. Thanks for asking that. More often than not, most founders think it's only equity. So thanks for bringing this conversation around debt. debt is a very valid and open instrument for founders to very much leverage. So just like you said, and I should really highlight, if you're going to raise a debt fund, make sure that maybe there's already markets to serve. There are clients base already waiting for you to deploy and serve them, and then you can quickly get your cash in to start paying out these debts. Because some things to note about debt is, number one, man, there's the time frame around it, right? So you meant what's the payback period? Is it 12 months? Is it 18 months? So you really want to hit those payback periods so that, to avoid accumulated interest. Second thing is still on interest, right? Are the terms favorable to you as well? The interest rates. I don't know what the current interest rate is at, but I think it used to be very, very poor or very unfavorable to founders. So founders just shied away from raising debt for a while. So think of the interest rate. Do you think with the current interest rate and the current amount you're looking to get, if you get that money from a debt financier and you're able to serve your clients and you pay back with interest, you still have some money for yourself, right? Like a profit. So think of those two major things, the payback period, if you have a client base to serve already, and the interest rates. Now, where do you find these debt financiers? Sadly, they're not as prominent or they are not as easily accessible as equity funders like the VCs, sadly so. But you can as well put yourself out there to ask these, right? With whether an investor community or founder community, try to push out a couple of requests. Okay, how can I get access to a Okay, try to get access to some of these debt financiers. If you have a chance to speak with VCs as well, you can ask them these questions because they sort of have these debt financiers as partners, even within their ecosystem, right? I know a couple of VCs who co-invest with debt financiers actually, who share notes and run due diligence alongside debt financiers. So yeah, you can also approach VC analysts or VC players to solicit intros, or just come to scouts like us. I also have a few debt financiers that I share deals with. Yeah, I hope that helps.
Thank you. Fee, I hope that answers your question. I see Candy, you have your hands up.
Yes, it does. Thank you very much. So sent you an email.
Okay.
Thank you so much, Ayola. I have a question. Yes. So my name is Kendi. I am currently been working in a startup, this particular startup for kind of like 2 years, and I'm moving to VC. And recently, I got within my networks got a company that is undergoing a funding round. Is currently in a funding round, and I believe that's more or less scouting for them to get a VC that can partner with them. So my question is, what has made you successful for this long to ensure that the startups that the startups you're working with and that you are looking for and scouting for are well aligned to the VCs? And also, what would you advise me as one who is starting off in scouting as well as in VC, like VC venture building and all that from the ground up? What would you advise me to do? Networks to be in, groups to be in? Yeah, thank you.
Yeah,
I like the spin to this question. I really love the spin. Ben, I'm looking for what you want to say.
Yeah. This is where I dropped the bomb. Two things, more than two, definitely. First is scouting is a very beautiful space to play in because you're sitting at the center of everything. I've seen people leverage it as an inroad into VC, like practically. I've seen people leverage it to start out amazing outfits. I know Shegun Cole, you know Shegun Cole, right? We started off scouting together. Now, yeah, his own has morphed into
M&A.
M&A.
Yeah.
I know another scout, Lamin Dabo is based in Sweden, I guess.
Senegal.
Yeah, but the Senegalese. Yeah, he's built a platform that's currently rivaling DocSend.
Yeah.
Yeah. So scouting, there are lots of opportunities and insights you can just get just from being at that center where you're being an infrastructure for deal sourcing, deal sharing across ecosystems and across markets. But how has that worked out primarily for me? Definitely a way to stay relevant is being very big on relationship building. So I proactively put myself out there. Relationship building. So for me, you won't see me in a lot of conferences, but mixers, private hangouts are sort of like my thing where I'm sure of the focused audience I'll meet there. So if it's a VC mixer, I'm sure I'll meet a couple of VCs there to build that relationship with, to tell them, oh, I'm a scout. You want amazing deals? DM me. Let's exchange contacts. So those very focused meetups is where you find me most times, and less of conferences, like full-blown conferences. Another thing that has worked for me is proactively training other scouts. So people that are interested in scouting come to me and like, Ben, how are you doing this? And then we walk through the whole track together, end to end. And then they're like, okay, I get the gist now. I also want to find my own expression in this. And then they go off, they go on to start their own scouting endeavor as well. Yeah. But also, I've also alluded to some of the things I said earlier regarding how I source for deals. So you're as relevant as the quality of deals you're finding as a scout. If your quality drops, your relevance starts to drop, in that sense. So you want to, can you still hear me, Ayola?
Yeah, we
Okay.
can hear you.
Okay, that's to be sure. You want to be you want to be at the cutting edge. You want to be sure that you have access to quality deals, because VCs really know quality work. At some point, the deals you're sharing are not whetting the appetite. They just might archive your message, because VCs can be very unemotional. Sorry, it's showing it's network unstable on my side. I just want to make sure.
Yeah,
Okay,
it
I
was
think
for a minute. It was for a minute, but it's
right.
much better now.
Okay. So yeah, your quality of deals directly impacts how much you're able to foster or keep these relationships with VCs for as long as possible. I mean, I started scouting for maybe 10 VCs at the time, and now having to share this with 70 VCs, that's a lot of numbers. So I've been very, very practical about the kind of VCs or the kind of startups I'm finding. Another thing that you want to get right is learning about the thesis of all of these VCs. So I have my own database of all of these funds and their thesis, state, sector, geography, ticket size, how timeline to funding a startup, and extra information, so to speak. So some VCs will tell you, oh, we prefer female co-founder. All of those details, you need to have it so that when you're sharing deals with them, it's within their thesis or it's within their mandate's focus. You're not sharing deals that are like opposites. Because if you start to share these deals that are opposite with their focus, you would lose them. It's very easy to lose them. They just see you as, this guy is not serious, or is not giving us what we want. So yeah, learn about their thesis, build it out effectively, source for deals, and share deals only that fits into their thesis, so that you can also get a good conversion. Conversion means them reaching back out to you to ask for intros to these startups. That's a good conversion, right? And of course, a good success rate is them actually funding those startups. But even seeking intros in the first place is that's how I measure conversion in the first place. So yeah, those are the few things I can speak to. And I'm just going to share it here. I'm actually launching Africa's first Scout Academy, where I'm actually going to be training people on how to be scouts. Yes, 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 yes. Thank
That's
you.
my handshake for you, Ben. That's a great one. I love that.
Yeah.
I was going to lay out a question to Candy's question. What are those vanity metrics that scouts shouldn't follow or shouldn't chase? What are those vanity metrics?
Yeah, vanity metrics scouts shouldn't chase. Because, well, again, as a scout, you're not thinking for yourself, you're putting yourself in the mind frame of your VCs. So the same vanity metrics VCs wouldn't chase, you shouldn't also be chasing them, because you're not the one funding the startups. The VCs are funding. So, but as a scout, again, you want to be careful of founders that are, again, let me be very clear. You want to source quality deals. Number one, what that means is founders doing amazingly well in terms of traction and market positioning. So for me, a vanity metrics would be you blowing up your numbers but no actual traction. So for example, GMV is a vanity metrics to me. It doesn't translate to actual revenue. I want to see actual revenue, not $1 million processed, and I'm seeing 2K MRR. That doesn't add up. I won't fundraise for you. Like literally. So I want to see actual traction. I want to see actual upward progression in what you're building, right? So that's a vanity metrics I always look out for. Always. Another would be, yeah, I think you spoke to it a bit, Ayola. Speaking of accelerators, a couple of founders overhype or overvalue accelerators. So just because you went through an accelerator doesn't translate to the fact that, oh, yes, you might have gained a couple of things, but it's not still wholesome. So don't brag about the accelerator you've been through. It's not really necessary, right? Take your learnings from it and build with it. So, but if I see a founder pasting several 2 or 3 or 4 programs they've been through, I'm like, why do you have to go through so much programs? Are you actually having time to build, or it's just about the several programs you're joining? So yeah,
Ben, you're shaking tables. You're shaking tables, Ben. You're shaking a lot of
yeah,
tables.
we have to be honest. Yeah, but I'll stop here.
So that I don't break the table. Anyway,
Actually,
I think that that was a good question, Candy, and thanks for asking. I think that my honest take as well is that as a scout, Ben, you sit across the ecosystem, right? And you mentioned it earlier, you're speaking to investors, either directly, you're speaking to VCs, you're speaking to angels, you're speaking to family office. You're like the guy on the field for them, right? How valuable, right now, just speaking to the scout ecosystem, how valuable is the scout, right? In such a way that you guys do the correctness in the markets. The scouts itself as that set of people who can do the correctness to the market. Or
okay.
the scouts, even the issues. Because again, the ecosystem has morphed from the period where founders do introductions to founders. So founders who have raised before just introduce their friends of
Yeah.
friends. Then the investors
Yeah.
are investing within the same
Yeah.
set of circles, right? Friends of friends and friends of friends. And it seems like you need to be in that, again, an early stage founder would think, I need to be in that caucus for me to be able to raise, or I need to, leak bots for me to be able to get into that caucus. So for me to get into that caucus, I need to be anywhere they are to get into that community, and then for them to be able to recognize me for me to raise. But we've seen a shift of founders who nobody even knew, right? Who have put in the grits, who have put in a lot of effort to build products, and now they are not even in focus. How do we balance all this in such a way that there's substance, a bit of hype, because of course, at the end of the day, when you raise money, you're going to come and make noise about it. How do we balance this with a lot of rejections, and the rest of it? How do scouts correct this market?
Yeah. So one of the ways we correct this market is my emphasis as a scout is to place the spotlight on underrepresented founders. Like I said earlier, I've seen founders that are super low-key, but they've built amazing stuff, but they just don't have the social capital, or they themselves are not really big on pitching or putting themselves out there. So if scouts are very focused on spotlighting underrepresented founders, then we've broken the mold of that caucus, right? Founders supporting other founders in their circle to access capital. So that's already one value proposition that scouts bring to the ecosystem. Another thing we're bringing is most scouts are also venture builders. Why? Because we also sort of support with investment readiness. Because we know that we can't present you to a startup, we can't present you to a founder. Sorry, I'm mixing the words now. We can't present you to a VC when you're ill-prepared, when you're not all put together. So we tend to run a little bit of venture building or investment readiness, to say the least, getting your books ready, your numbers, your pitching, your stuff. That's one of the things we're doing to create a smooth transition and a better ecosystem. The third is just access to investors. Like I said earlier, my startup failed woefully because I just didn't know who was funding what, right? So as a scout, I can tell you, you know what? Don't speak to that VC because his theses don't align with your startup. So scouts already have that information of all of the theses of these founders. So in order for you not to waste your time as a founder, a scout can tell you, okay, these are the list of VCs you should be speaking to because their thesis or their mandate aligns with your startup in terms of stage, sector, geography, traction, all of that bits. So we help sort of cut through the noise, get to the point of it, and then make your startup as aligned with the right VCs as possible. So yeah, that's another very key. That's how we're also correcting that space. Maybe lastly, speaking of rejections, so some founders really don't take rejections very well. Most founders think if a VC tell me no, then I'm bidding the wrong thing. Most times you are only speaking with the wrong kind of VCs. Trust me, I've seen founders think, oh no, I'm not onto the right thing. No, you spoke to a VC who doesn't understand your context, who didn't understand what you're building for, who you're building for, right? So again, scouts sort of help you deal with such rejections to let you know that, oh, perhaps you spoke to the wrong VCs. Secondly, we help you understand that it's a journey. This is not the end of it, right? So we are that support system to founders to let you know that yes, you might have gotten 10 rejections from VCs, but can we re-strategize? And this is what I do with founders most times. I tell them, okay, we've put a deal out there. No VCs came back positive with a positive response. Can we re-strategize? Re-strategize can mean that, you know what, let's take a step back from fundraising. You go build a little more traction. Let's come back. Or it could be, can we break down the funding round? So if you're raising 1 million, can we split it? 500 first in first tranche, 500 in another tranche. I've seen that to be a solution for some founders because you can easily get some quick checks from one or two VCs that are willing to write 50K here, 100K there, and then you close the initial 500 tranche. So there are always ways or strategies to think about how you're fundraising that might not be readily available to founders, but scouts already with failure of fundraising that founders are facing. Yeah.
All right. Thank you, Benjamin. Thank you, Ben. If you could give founders one piece of advice to move from hype to substance, what would that be?
One piece of advice to move from hype to substance: build sustainably. Yes, it's looking like a buzzword in today's world, but it is what it is. But build sustainably. What that means is this: don't build a venture that would essentially survive if you didn't have to raise any capital or if you didn't have to raise additional capital, right? Because some startups are built in a way that in order for them to survive, they just have to keep raising. That's the Silicon Valley model. In Africa, where capital is not readily available, you need to rethink how you're building. So can you build sustainably in a way where, when the market runs dry, when VCs are telling you no, the lights are still on. The lights are not just on, but you're hitting your milestones bit by bit. You might not hit it aggressively as you'd want to, but there's an upward positive progression in what you're building. So that's definitely one way to build for substance and not for the hype of it.
All right, you have a question here from Farouk. He says, does scouts get paid before putting founders out to VCs? I mean, in most cases. How do you make money? That's what he's trying to say to you.
Yes. Most, like you said, in most cases, scouts ask for a fee. It could be $1K, $5K, you name it, just to get you access to VCs, which I personally find unethical and very unfair, right? Because founders are already struggling to stay alive while still build them. So my model is I don't charge anything upfront. So there are no upfront costs for me scouting for you, right? So I rather deploy this success fee model where I charge a 5% success fee when one of my sense is performance driven. So when you get paid, I get paid. That's how to build. And here is the upside to doing this that a lot of scouts sort of have missed out on. When you deploy the success fee model as against an upfront cost, let me play out some scenarios. I've seen that when I charge upfront, I chase away top tier quality founders. They can afford to pay you, but they just don't see the value in paying you. And they're like, I'd rather not put my money here. Now, if you're able to deploy the success fee model, you will get them to definitely come on board with you. You get to definitely scout for them because they are top tier. Chances are that they'll get funded and you get paid anyway. But guess what? When you get paid, you've built a level of credibility with them that nobody can take away. And they'll be very quick to introduce you to other founders in their network. They're like, oh boy, chat with Ben. He just helped me raise X amount of capital. And guess what? No upfront costs. So that's immediate marketing, organic marketing for you to other top tier founders in that sense. And so, yeah, if you deploy my model, you definitely have to have something else doing on the side because you need to stay alive.
I
Right.
to say that if that works if you were an individual just scouting, if you had a group of scouts and you had to pay them salaries, then that would also be another model to consider, right? But again, I like the model, to be very honest. While you were speaking, I was reconsidering our marketplace model, because of course, at Umbrella, we charge founders to be able to run DDs, to be able to do some investment readiness checks, to be able to keep your data room ready for investors. So those fees for subscriptions are not like you're paying Umbrella for it. You're paying for services for us to be able to keep those things in place for you and run the DD, because for us, everybody is verified, right? So verification is also very important, and we pay for those verifications with our third-party partners. So I think it's a shared cost. It's like you're paying for your own investment readiness check before you get in front of VCs. But again, while you spoke, that was a very, very interesting perspective as well. And I'm thinking I would just have to have conversations with my team on how do we balance the industry, right? But what are those market shifts and trends? Now I'm taking you to another place where you might not want to be. What are those shifts and trends that we should look out for within the investment space as founders, as investors, and as scouts? You wear three hats, Ben, only you, right? In the next quarter and let's say maybe 2026, what are those trends that you see that would happen in the market, in the investment world?
Okay, in the investment world, some of the market shifts. Something I've already noticed is
Let's
I
do
haven't seen.
let's do shift and correctness.
Okay, shift and correctness. Let me think through this one. So for founders, let me pick it stakeholder by stakeholder. So for founders, one of the shifts and correctness that founders should be looking forward to seeing is, which is already happening, VCs taking time to run extensive due diligence. So founders already use the notion that, oh, it will take me just a quarter to fundraise and I'm back at building. Charlie, no, it might take you a year to raise that capital. No, this is so real. I've launched fundraising campaign for some of the most amazing startups. Startups doing north of 100K MRR, and they're still struggling to close 200K MRR, still struggling to close seed round. And you're like, what's going on? So I think one of the things founders should note is you really want to learn how to build an effective runway so you don't burn out of cash before raising capital. Because guess what? Things are becoming a bit tougher. Like cash is becoming becoming harder to access. So you want to rethink how you're building. It's better to build slow and steady till you raise capital than you scale than to burn all your cash and before you even access capital, you're out of the market already. So think of increasing your runway and increasing your timeline to fundraising. If it was 6 months before, stretch it out to a year plus. If it comes in trinkets, fine. Like you raise 100K within a quarter, 300K the next quarter. And that's why I buy the idea of constantly fundraising in that sense. So you're constantly out there looking for or speaking to VCs on the low, so that at any point in time when money comes in, you're able to push forward, you're able to increase momentum. So that's one trend I definitely see happening. Speaking of correcting it, well, it's here to stay. LPs are becoming, we're not seeing as much LPs commit to VCs as we used to see. Some of our top VCs have shut down this year. Think of Footfall Collective. That was a very huge blow on the ecosystem, right? So if VC shut down, definitely it affects the entire value chain, right? So that's one thing I can speak to. The other thing I can, since we have more founders on this call, another market correction that you really want to think about. I've mentioned it earlier, but for emphasis sake, please work on your valuation as much as possible. I've seen founders raise 15 million. I'm like, looking to raise as 15 million post money, but I'm like, no, let's cut it into half, right? Because I've sort of scouted for a couple of startups, so I know the ideal valuation you should be raising at a particular stage, whether pre-seed or seed, and at a particular traction, whether 10K MRR or 15K MRR, right? It's just a market comparison over the years that I tend to fall back to. So try to raise at a very reasonable valuation, please. Let's correct the market ourselves as founders and not just raise at ridiculous valuation. So yeah, those are the two things I'll speak to. Adjust your runway and stretch your investment prospects, then adjust your valuation, right, as much as possible.
Let's go to the scouts and then the investor side of things. You picked only one stakeholder.
As a scout, I would say, again, I'm a core Christian, very core. When the Bible says, cast your bread upon many waters, scouts might be required to stretch a bit, to not just think of speaking to VCs within the African landscape, but actually plug into other foreign ecosystems, get the buy-in or interest of VCs and get them interested in African startups. I do that a lot. I've done that in the past. A couple of US-based funds, I've gotten them interested in some African-based startups here in Africa, sub-Saharan Africa to be precise, right? So think beyond your geography. Think beyond SSA as a scout. Think of North America. Think of North Africa, right? And that's something I'm currently building as well. I'm trying to build a bridge with some North African VCs, right? Like the Plug and Play, the V3 Factory, the Sawari Ventures, getting them interested, Flastis Labs, which has already built out an SSA wing already, get them embedded in the sub-Saharan African landscape. And we just might be shocked to see what will turn out in the next couple of months, right? We're going to see some cross-border, cross-ecosystem partnerships and funding opportunities, even co-investments and even our companies scaling into that market. Like a lot could happen with both regions. So as a scout, is that season to also look beyond the usual suspects, right? The launch traffickers of this world, the aggressive capital of this world. Look beyond those guys. They've done an amazing work in the ecosystem, but let's stretch further. So that's one thing I can also mention. So the third stakeholder, right? Investors. I would say as an investor, you also want to rethink, um, hmm, you also want to rethink how you go about due diligence in the coming months or in the coming quarters, because due diligence for me, for most VCs, is a textbook format. So they have a template and they punch in numbers or figures or insights. And if it doesn't match their templates, then you're not the right fit for them. Well, that's tricky, right? As a VC, you also want to be
Evolve.
flexible.
Yeah, you want to evolve.
You want to evolve, trust your gut feeling more, speak to more stakeholders more. Take time out, wait on things more. Don't just be too quick to tell a founder you know. This is where a lot of investors turn up regretting when they miss out on an opportunity. So really take the time out to due diligence. Don't be in a hurry. Have some more conversation with founders. Speak to ecosystem players more, whether it's scouts, whether it's venture builders, ESOs, spark conversations, get people talking so you can be very well educated, knowledgeable about a particular space, and you can decide whether you want to make a bet or not.
So I
Yeah.
was even going to say something before I take the two questions in the chat box. I was going to say that aren't we seeing that investment in the real sense of it is a risk on its own, right? Aren't we seeing that investors are even playing? They're trying to. I know you would say, "Oh, edge your risk against a bit of safety and all that," but investment in its real sense of it, isn't it a risk? The probability is either 1 or 0 in most cases, right? So. Um, why are VCs trying to be overly safe? I know VCs because the funds are not theirs, but investors, direct investors themselves, why are they overly safe? Do you want to also speak to that? Because like some founders here on this call probably say, he's not willing to take a bet at me. How is he sure that I'll be the next camel or unicorn out of Africa?
Yeah. So are you talking about VCs or LPs?
LPs itself. I'm speaking about LPs and GPs.
Okay. So LPs again are the ones are the funders, the ones that fund VCs, right?
Yeah.
So again, it boils down to their own framework. For some LPs are more of a risk taker than others, right? And so they're able to trout a number of funds, and if they get 2x return, it's fine. And then there are several kinds of LPs, right? There are the CVCs, there are the endowment funds, there are the family offices. Like there are pockets of LPs and how that the corporate backers are corporate funds as well. But I essentially think it boils down to their framework of how they think about risk and their risk appetite as well. Are they in a place where they can afford to part away with X amount of fund, whether or not they get a return? Or another way to think about it is how patient are they as well? Can they be patient with this ecosystem for the next 10 years, or rather than having to look for the next most prospective founder to just invest in, right? So, for example, if Launch Africa has invested in a startup, the LPs of Ingressive Capital quickly want to deploy capital to Ingressive to invest in that same startup, right? Yes, you can go for the usual suspects, but do you want to also bid patiently and look out for those gems within the ecosystem as well, right? But one thing I find very interesting is seeing LPs who also have a very strong domain expertise or strong focus. So LPs looking to invest in female, for example, or LPs looking to invest in a particular sector, in a particular niche, those LPs tend to be more resourceful and more guided in their decisions. And it just tells on the ecosystem that, yeah, these guys are really here for the impact that they will derive from this particular space. So yeah, I think that will be my take on it.
Thanks, bro. So back to Candy. She's asking, how is AI changing the VC world, especially scouting?
Wow, wow. As a scout, well, for myself, I've had to build manually, very manually over the years. Simple Airtable, punching in the database and the data points and all that. But speaking of AI, at best, these are the tools I leverage to run my day-to-day engagements. So I leverage Airtable. That is where the list of my VC seats, list of my founder seats, and then my tracker in terms of the VCs currently engaging each startup and where they are in that conversation, right? So I use Airtable. Then I use Pitchwise. Again, we spoke about Lamin, who was a scout now, now turned founder of Pitchwise. You know, they're taking market share from DocSend very quickly. So I use that platform to present decks to my VCs, and then I check out the analytics on the back end. Which VC is viewing which deck? Which page are they spending more time on? Why are they spending more time on this particular page? How can I proactively reach out to them to ask, okay, I see you perusing this particular page on this platform. Would you like to have interests? Would you like me to introduce you to this founder? I do that manually today, but I think how AI can effectively change the scouting space is all of this process being automated. So at the point when a VC spends a particular time on a page or on a deck, it gets an automated response from the scout, quote unquote, to say, okay, would you like intro? So just if I can see more automation across these operations, right, across how VCs are interacting with our pitch decks that we're putting out there, I think that would be a game changer. But today, AI hasn't proven to be very instrumental for scouts, especially in the coming months. Yes, maybe, or maybe it's just me being a bit conservative. I've not been as explorative, maybe. So yeah.
Well, I think to add to that is that I see some, I can't remember the platform, but they have an AI tool that gives you some percentage of, so when you upload your deck, you upload your documentation, your data room, it tells you the potential, I think it's called Vista or something. It gives you the potential for them to know if you are likelihood of you being invested in. I don't know how they've done that, but I'm sure that they are also using various investors' thesis within the back end to do it. I think there's just a lot of machine learnings that need to happen within that space. Again, we need to also see some scouts, some VC, some investors go into building out platform for investments.
Yeah.
Why I'm saying this is because that's still manually done some way, somewhat. And you can't just upload a pitch deck to an AI tool and expect it. Some VC do it, they just do page by page and then just say, okay, give me an analysis of this market. Is this like you query it? I think that's also happening where you query or you want to also confirm the size of the market if there are red flags within the document and the likes. But maybe more machine learning needs to happen within that space. And I don't see VCs building for it. Well, basically, a lot of us still just collect decks through forms, and then we just manually, analyze it. I think that there's still a lot of human elements in the VC space, to be very honest. That you don't want to leave that to machines to just do that. But I think that would change in coming years. It just needs to be a correctness in the market as well, and everybody just aligns, to it. Michael says businesses in the game of chance category, even when they are regulated or tied to social impact models, or often struggle to attract investors' interest. Why is that?
Hmm. Even when the regulators are tied to social impact models, often struggle. Do you want to clarify what games
Michael,
of chance?
do you want to unmute yourself and just speak? Even if you're in a noisy place, we will manage you for that. Let's get context. Hi, Michael, are you there? I hope so. I'm not sure.
If it's not, maybe I'll just take a stab at it.
Right.
So businesses that are tied to social impact models often struggle to attract investor interest. Why is that? Well, VCs, there are VCs that are more social impact driven. Some are strictly looking out for revenue and profit and scaling and all that. So it depends on who you're speaking to per time. I know a number of social impact driven VC firms, specifically based in the eastern part of Africa, a number of them, and they'll be happy to due diligence a deal, or maybe they're not big on traction, but as per hitting their social impact mandates, they are there. Whether it's offering clean water, whether it's in the education space, right? Yeah, whether it's solving gender inequality, you name it. Yeah. So again, it depends on who you're speaking to per time. But if you're speaking for, yeah, you want to say something?
I think my own take would be that I'd have allowed you finish, but I think my own take is that yes, you might fit my thesis, but there are still other things that I'm looking at within your entire framework. It could be governance, it could be traction,
Mm,
it could be um, team, it could be business models. I'm still looking at those things. It's not just because you are in my social impact side of things that I would, just jump at you because you are doing social impact. Again, Africa is used to jumping on the rail of buzz, right? So when AI became a buzz, almost everybody, when I jump on like some calls with demo days, I'm saying some people say, oh, something edutech, leveraging something AI. Almost everybody was doing AI, right? Even
yeah,
when you know that a lot of you weren't even building out your own AI models, right? A lot of you were just leveraging ChatGPT and the rest of the other AI components, right? So again, I know just the way some scouts or some platforms who do due diligence on founders also know that some of these things are just actually buzzwords. And every founder just wants to go with the real because they found out that some AI companies are raising or some social impact companies are raising. Then you include
mm,
social impact into what you're doing just because you think that that's what investors want to see. I think that one thing that key thing I take out from Benjamin's conversation today is be real, be you, right? Focus on your own solution, right? Rather than just adding buzzwords to it. And that might just be the unique selling points, to be very honest.
absolutely. Absolutely.
Finn says, interested in social impact VCs, building an edutech product.
Well, uh, so I'm part of this Lamar Impact Accelerator that's currently ongoing, right, by Meta. So I'm sitting as one of their mentors, and I am mentoring this edtech startup as well, based out of, is it Ibadan or where now?
Mm.
Um, and they are very much AI driven. But my question is really, which VCs have funded edtech startup in the past 2 years in Africa?
Mm.
Yeah. The edtech space is becoming very, very interesting. I won't say unattractive, but interesting. Um, because for some reason, problem of scalability is there, consumer buying power is there, product
Behavioral
sticking.
patterns as well.
You say what?
Behavioral patterns of the consumers.
Yes, yes, it's there. I mean, it's interesting, but Finn, I'm keen to learn more about how you're approaching the market. If it's really enticing or interesting, we can definitely push for it.
All
Yeah.
right. I think that's my question for today. I don't know if there are other questions before we call it a wrap. Ben, thank you for joining this call. I'm looking forward to your announcements on this. But Ben, I want to ask you one last question.
Yeah.
A startup
Yeah.
announcement, is it a hype in most cases, or how best do you advise that we go about it?
It's a hype, but it's a good hype. It's just something that has come to have its place in the startup ecosystem, so to speak. Because why is it a hype? It's a hype because, again, you could have as well just kept quiet, bury your head in the work, and just keep building, right? I've seen a couple of founders do that. They don't make one noise about their fundraise, and you won't even know until like 5 months later or 6 months later. And they are totally fine with it. Some of them will tell you, well, to avoid too much eyes, whether from regulators or competitors or whatnot. That's why they just chose to keep it off the radar or off the buzz. But why I think it's a good hype too is I've seen a number of founders get very strong introductions just because they raised a new round, because it attracts all forms of stakeholders, right? Whether it's customers, even your competitors, or even potential VCs that will partake in your next round, you know. So making noise about your fundraise is a good hype that I would encourage you doing, especially where you fundraise from notable VCs. Yeah, it just puts out a good signal for other VCs to pick interest in your next round, so to speak. Yeah.
Thank you. Thank you. What is the role of venture builders, venture studios in all of these conversations? And then after that, just give us your parting words, so that I don't also drag the conversation even further.
Yeah, I mean, it's just been a very rich conversation, but yeah, thank you for curating this. The role of venture builders and some of these players are this is my own feedback. I don't think we've seen a lot of amazing work from them in the coming years. Some are really doing good jobs. I know a few, but I just wish we had more and more really solid ones, not the ones that's just making noise about, oh, we incubated 10 startups, demo day time, after demo day, nothing. Um, I really think that they play a critical role of helping founders build the right way. Most founders are first-time founders. African market is very new. It's still very nascent. So most founders you come across are first-time founders who need quite a lot of hand-holding, insights, support, real-time support. So they play a critical role of ensuring that this narrative of startup shutting down within their first 5 years is very much reduced as much as possible. They have that role of ensuring we see more scalable startups, more startups going on to raise seed rounds, Series A, I mean series rounds, even scaling beyond Africa, hopefully getting to go public. The venture builders, really, that's their niche, that's their focus. If we could see a lot of players in that space really pulling in their muscles together, I think the entire ecosystem would be a very good virtuous cycle in that sense, very virtuous cycle. Um, yeah, so that's
Ben,
the respect to that.
I know I promised my last words, right? But I was going to ask you
Yeah.
a question before I saw the comment sections. My question to you would be, how does the current narrative around African founders, the ones who have collected the large funds, who have failed, who have failed, I like to say failed forward, because of course there can always be a comeback, but who have failed, how does that narrative of Africa, the trust in founders, the broken gap of transparency, how does it affect even you when you speak to investors? You know that there's one place in your heart that you don't know if that founder is going to squander that money or is going to live a lavish lifestyle, or is going to go about his daily activities and impress the investor. How do those narratives affect the job that you do within the African ecosystem? And I know that this is a conversation in some of the communities that you belong to. The narrative or the look and feel around Africa. I don't want to say Nigeria because I know it's an African-wide problem.
The look and feel of African founders going about lavishing money, is that the question?
The narrative around us, like if you invest in Africa, that's why I think that's where the skepticism for some new investors still play, where you see some top African founders still shut down. Does that narrative affect the job that you do, raising funds for founders?
Yeah, well, first off, it's not even an African narrative. I think across markets, everybody's still dealing with their own. Which is why I love it when the media really picks on founders or startups doing the right thing, such as maybe returning X amount to VCs. It means that, yes, there's still some good eggs here, and there's still the ecosystem here is still very promising. So I really love it when the ecosystem makes some noise and some buzz around founders returning funds to VCs. But how does it affect me as a scout? I think the impact on scouts is not so much because there's only so much we can do as scouts. And let me shed some light on that. VCs understand the game. They know that, founders are very interesting people. Most times you can tell them what to do. So sometimes they go about doing exactly what they want to do, regardless of, regardless. So if VCs can't handhold them as much as possible, then the pressure shouldn't fall to scouts who are more like contractors, right? So we don't have as much influence over founders. We can guide them across several areas, but we can't necessarily, coerce them to do certain things. So that narrative really doesn't affect scouts as much from that perspective. The best we can do is keep highlighting the amazing startups doing great things. And when the ones that sort of go about things the wrong way, do that, then it's also our duty as scouts to emphasize that, yeah, it's not this startup founder behaving like this doesn't necessarily depict that the entire ecosystem is like that, or majority of founders have that same character or that same. So we have the job of also crafting that belief system or shifting it as scouts, because yes, actually what it is, when you sit in a scout role, you are also what's that word? A voice. So sometimes VCs would not speak to founders to get insights. They speak to scouts to get our take on specific founders and specific things happening in the industry. So scouts should know that we also pushing out as much we have the backs of the founders doing the right thing. Yes, founders would always misbehave every now and then, but we can control that. What we can control is a narrative as best as possible to ensure that the good founders don't suffer for that.
Thank you, Ben, and thanks for the good job that you do. Parting words, your final words to everybody on the call. And then I just do an introduction of the next speaker for the session. All right.
Yeah. Parting words, I believe we have mostly founders on this call. I would say that, man, be build very intentionally. What that means is, yeah, avoid that race of comparing yourself with another established founder or startup. Yes, you can quickly find yourself running a rat race or being in an unhealthy space where you're not, unearthing the gems you're meant to unearth, but you're figuring out what's working out there and comparing and just copying and pasting. Take your time to build something that will last that will be transgenerational, that will outlive you, outlive your children, outlive the next generation, if possible. Build for the long haul. Build slowly. Sometimes the solution is not even to raise funds, is to really figure out your product market fit first with as much little capital as you can lay your hands on. Because VC money will put you on an entirely different track. Trust me, it always does. Build the right ecosystems, the right networks, get yourself in founder communities as much as possible. Be very intentional about building those relationships. Yeah, some relationships will start paying 5 years, trust me. Some relationships are not immediate, some are that long term. So, and I know how it can feel to building your startup can keep you in that box where it's just all about you, your team, your product, and all that. So every once in a while, step out there, figure out what's working and what's not working in the ecosystem, and learn. Open yourself to learning, unlearning, and relearning as much as possible, as much as possible, right? And more than any other thing, if you're a believer, trust God. Yeah, man only knows so much. Yeah, trust the one who knows everything. Yeah.
Thank you.
Um,
Thank you very much, Ben. Thank you very much. Thank you very much. You've been an amazing person on this call. I remember our first conversation where we spoke, and it was very insightful. You want to talk about some of the things you're building, just as a wrap up call, just for those who didn't join the call early enough.
hmm,
So just hear some of the amazing things that you're doing, and we'll just close it there.
okay, amazing. So Benjamin, beyond being a ventures, I also lead events at A&A Collective. So if you go through my LinkedIn profile, you see that A&A Collective is actually Africa's largest community of investment professionals, the largest so far. I think we're about more than 500 members strong across Africa. And so my job there is to curate events for the community. So for example, I curated one 2 weeks ago on the sidelines of GITEX. So that's what I also do for the ecosystem. Again, that just tells you that I readily have a pool of investors to reach out to. Right. I also do that, and I also sit as the regional director of community for West Africa at Faith Driven Entrepreneur. It's a global movement helping Christian founders on their journey really to becoming better at what they do and glorifying God through their businesses. That's what I take my joy and pride in. That's my calling, actually. So, but back to what the future looks like for me when it comes to scouting. Like I said earlier, I'm launching Africa's first Scout Academy. It's been in the works for the past 2 quarters. So it's a live session and to be tutor-led. Some of our tutors, Shegun Cole is a tutor, of course, Lamin is a tutor, right? And a few very notable scouts. These are people that have been battle tested, that really know the onions when it comes to scouting. And so they are actively looking to pour themselves out as well. I'll also be tutoring, of course. It's set to launch in Q1 next year, but communications and marketing will kick off next month effectively. So if you're here and you want to learn about scouting as a way to get into the ecosystem or as an avenue to get into VC or for whatever objective or notion, then you should join up. The website is live. You can check my LinkedIn page to get that, and then put in your application already, and you can join the waitlist. Yeah, so I believe the future really lies on building very strong infrastructure, which involves building out a massive scout network to spotlight underrepresented founders and even pique the interest of foreign funders, get them into the ecosystem, and yeah, move the African venture space forward. Thank you.
Thank you very much, Ben. Trust me, I'll give you my support. I will be willing to push as much as I can to get that some of those contents also live life on Umbrella as well. However that works, whether by API or direct uploads. We would like to also house some of those contents on Umbrella and then get it to more people. For us, we just believe in bridging the gap, right? And that takes me to the next conversation. She's on this call. I'm sure she's just waiting for me to do some very nice introduction. So next week on Umbrella Saturday, we'll be having scaling in Africa, growing a business in a fragmented market, and that will be Udokwu. Udokwu is the co-founder and CEO at Shuba Capital. She's on this call. Udokwu, do you want to just say hello to us? Because it would be nice to hear your voice. I'm surprised that I didn't hear your voice today, or any questions for Benjamin. But Udokwu is someone that I also follow closely. I see a lot of work that she's doing. She's a founder, and she's just going to come and give us some founder perspective to how she's been able to scale in Africa amidst the fragmented market space that we have. So, Udokwu, are you there?
Hi, Ayola. It's the weather, the cloud and the rain, everything is just a bit cloudy around here. So that's part of the reasons why you didn't hear me speak. But well done, Benjamin. That's been very eye-opening. And thank you, Ayola, too, for putting this together. I mean, as we build, right, we need a community of people, whether founders, whether scouts, whether investors. We need to compare notes. And I am very fortunate, right, to be on this call today. So yeah, thank you, Benjamin. Thank you, Ayola.
You're welcome. All right, guys. We call it a wrap. See you guys next week. Ben, see you soon, and then you wait for my recap. All right.
Looking forward to it.
All right.
Thank you.
Have a great day, guys. Bye.